If you have any kind of formal finance background, ideally you are better off not investing in a mutual fund because it doesn't take a genius or a high IQ to pick investments on your own. Mutual funds are a great product for beginners or non finance people, but not for you if you understand the basics of money and capital markets. Here are 10 reasons not to invest in a mutual fund. Number one, they are middlemen. They will eat away at your overall annual returns. Why would you give your money to someone else to manage when you can do it on your own? Number two, the fund manager's interests are not aligned with yours. What do you think the fund manager is more interested in? Retaining his job as a fund manager or trying his best to grow your wealth? It really doesn't matter if you make money or not. The fund manager will get his salary. The fund house will keep charging you fund management fees on the assets under management. Number three, mutual funds are in the asset gathering business. There are a lot of money management businesses in the world that have deliberately chosen to remain small in terms of assets under management. They truly want to be in the asset management business. They don't want to be in the asset gathering business. Which business do you think the mutual funds are in? The asset management business or in the asset gathering business? As I said earlier in one of my blog posts, if you do not understand the game will be played on you. Always remember that statement. If you do not understand the game, especially in the world of money, the game will be played on you. Number four, fund managers won't beat the market indices. In the short term, yes, some fund managers can show some success. However, over very long periods of time, the chances that a fund manager will beat the market index is very low. And by the way, that there is a lot of research done on this subject. Beating the index is a game that is best played by avoiding it altogether. Number five, you have no control. You invest in a fund, then you go and check the portfolio holdings. Maybe it has a company that hasn't made a dime in the past 10 years, meaning it has no ability to generate a free cash flow. What can you do about it? Can you call up the fund manager and say, please remove this company from the portfolio? You really can't do much about the situation, right? Other than get rid of your mutual fund units. Number six, your favorite manager calls it quits. You invest in a fund because you like a particular fund manager. What if he quits the company? Are you going to sell your units? Are you going to move your funds to where the fund manager is joining next, maybe the next business? Wouldn't selling your units incur an unnecessary tax liability for you? Why would you have to pay tax just because your fund manager quit the company and is joining some other asset management business? In such a scenario, to avoid paying taxes, you will have to settle for some other fund manager whom you might not know that well. Number seven, the inability of mutual funds to sit on cash. Mutual funds cannot remain on cash for too long. Eventually, they have to deploy the money as per their mandate. Whereas you, on the other hand, can choose to sit on cash for years until your favorite company reaches a reasonable valuation where you now feel comfortable getting in. That, by the way, is the method used by the most successful investors in the world. They operate with extreme patience. Number eight, the fund manager cannot speak the truth. Imagine the economy is crashing. The central banks are raising interest rates. Asset prices are under pressure. Is the fund manager ever going to say the market is going to fall in the coming years? Well, if he does that, he will face redemptions in his mutual fund. So even if the fund manager is super bearish on the market, he cannot speak his mind out. Number nine, your fund manager cannot invest in almost any company. You, as an individual investor, can invest in any company in the stock market that you want, be it a blue chip company or a penny stock. The fund manager cannot do that. He is supposed to follow a particular mandate. Even if he likes a particular small cap company, he cannot deploy funds there since he has been given a mandate to invest only in large caps, maybe. Yes, you can choose both a large cap and a small cap fund for your portfolio, but that will force you to take exposure to other small cap companies in the portfolio which you may not want to invest in. Number 10. The fund manager cannot react quickly to bad news. You, as an individual investor, can simply choose to close all your positions and stay away from the market if you predict something really bad happening in the future. Your fund manager cannot go to 100% cash in a single day. The funds have to remain invested as per the mandate. As long as that is done, the fund manager's job is safe. So, those were the 10 reasons I wanted to discuss with you today. Mind you, I am not saying don't invest in mutual funds. All I am saying is that if you come from a formal finance background and if you understand the game of money, you are better off not outsourcing your money management to someone else. Do it on your own. You are most likely to do well because in that case, you will have more flexibility. Thank you so much.